Hi students, welcome to SolutionInn YouTube channel. In today's video we will learn about shares buyback. Shares buyback, also known as stock buybacks, refer to the repurchasing of shares of stock by the company that issued them. A buyback occurs when the issuing company, such as Apple Incorporation, pays shareholders the market value per share, for instance, let's say $25 per share, and reabsorbs the portion of its ownership that was previously distributed among public and private investors. With stock buybacks, the company can purchase the stock on the open market, as in on the stock exchange, or from its shareholders directly. For example, in case of smaller companies where major shareholder are very few people, so management can approach the shareholders in a meeting and agree on the buyback. In recent decades, share buybacks have overtaken the trend of dividends as a preferred way of returning the cash to shareholders as a return. So the smaller companies may choose to exercise buybacks, but blue chip companies such as Apple, Amazon, and Walmart, etc., are much more likely to do buybacks because of high level of cost is involved. So companies do buybacks for various reasons. There are multiple reasons. We'll discuss them one by one here. So the reason for buyback can be companies going to consolidate its operations, or equity value may be too low and company wants to increase the equity value, and it can also be financially very company's picture is looking not financially very good, but company wants to make it better, to make it look attractive for investors. So these can be a few reasons for repurchasing these shares. So there is also a downside, because share buybacks are normally financed through debt, and it puts lots of pressure for the on the profits, because there are large finance costs related to the such a debt financing. So we'll discuss the reasons for shares buyback one by one. So first one is the company has excessive cash that company is no longer able to invest somewhere or to generate some return. So each share of common stock represents a small stake in the ownership of issuing company, including the right to vote on the company's policy and financial decisions. For example, if a business has a managing owner and 1 million shareholders, it actually has 1,000,001 owners. So companies issue shares to raise equity capital to fund expansion. But if there are no potential growth opportunities in sight, and there are no foreseeable growth chances, holding on all of the unused equity funds means sharing ownership for no good reason. So businesses that have expanded to dominate their industry, for example, may find that there is a little more growth to be had, with so little headroom left to grow into. Carrying large amounts of equity capital on the balance sheet becomes more of a burden than a blessing. So it is usually a very bad picture. Shareholders demand returns on their investments in the form of dividends, which is a cost of equity. So the business is essentially paying for a privilege of accessing funds it isn't using. So what are the funds doing in your balance sheet when you are not actually using them and you are actually paying the shareholders dividend on the investment they have made? So buying back some or major part of the outstanding shares can simply be a way to pay off the investors and to reduce the overall cost of capital. For this reason, Walt Disney reduced its number of outstanding shares in the market by buying back 73.8 million shares, collectively valued at approximately 7.5 billion back in 2016, just to reduce the overall cost of equity. Another major motive for businesses to do buybacks is when a stock is undervalued. Undervaluation occurs for a number of reasons, often due to investors' inability to see past a business short-term performance or a general bearish sentiment in the market. So if a stock is dramatically undervalued, the issuing company can repurchase some of its shares at this reduced price and then reissue them once the market has corrected, thereby increasing its equity capital without issuing any additional shares. So for example, let's assume company issues 1 million shares at a price of $250 per share, raising approximately exactly 250 million in equity. Some dramatic news floats in the social media, and company's leadership ethics causes panicked and shareholders are now panicked, and they are starting to sell the shares, driving the price down to, let's assume, $150 per share. So by such a sentimental trigger event, can be the price of the share can be reduced dramatically. So the company decides to repurchase out of 1,500,000 shares at a price of $150, because the current market price is really reduced 150 per share. So the for total buyback outlay would be 75 million, and wait out for the market to correct. After that, the business remains profitable and launches a new and exciting product line the following quarter, driving the price up to $350 per share. After regarding this popularity, the company reissues the 500,000 shares that it bought back in the new at the new market price of 350. So it would be definitely increasing its existing equity from 250 million to 350 million without further diluting ownership by issuing additional shares. Another third and most important reason that most of the companies do is that to make the business more attractive, and one of the key ratios that we can discuss here is earning per share. For example, a company that earns 20 million a year with 100,000 issuing shares, and the EPS would be, earning per share would be $200 per share. If it repurchases 40,000 of those shares, reducing its total outstanding shares to 60,000 only, its earning per share increases to 333.33 without any actual increase in earnings. So buying back stock can also be an easy way to make a business look more attractive to the investors. By reducing the number of outstanding shares, the company's earning per share ratio automatically increases. because of annual earnings are now divided by a lower number of outstanding shares. So one interpretation of buying back company financially healthy and no longer needs excess funds, it can also be viewed as a market that management has enough confidence in the company to reinvest in itself. But there is a negative side of how buybacks are normally financed. Debt obligations drain cash reserves, which are frequently needed when economic wind shifts against a company. For this reason, credit reporting agencies view such financed stock buybacks in a negative light. They do not see boosting earning per share or capitalizing or undervalued share as a good justification for taking on debt, and ultimately it influences the shareholders' psyche that they require more and higher rate of return instead of just uh, relying on constant dividend streams. So this is not a good justification for shareholders in general. So hopefully you have understood the concept of shares buyback, how we do it, and what are the most important reasons that most companies do share buybacks. So hopefully you have understood the concept. If you guys have any question, you can ask me in the comments, and you can always follow SolutionInn for more related lectures, and we'll be seeing you in our new video. Until then, take care. Bye bye.